Okay, so we're going to be talking about understanding college financial aid and paying for college. We will have time for questions at the end, and when it does come time for questions, I'll ask people to put them in the chat. So let's get started. I want to kind of open it up with a few fundamentals to kind of set the table, because a lot of people have some preconceptions about financial aid, and they're not always correct. So we'll just go over these quickly. One of the most important things is that what really matters in college financial aid and paying for college is gift aid, and that's grants and scholarships. Many people tend to focus on loans. Loans can be part of the overall package, but they really are not nearly as good as gift aid. So that's what we're going to focus on tonight. And another thing to keep in mind is that almost all gift aid comes directly from colleges. So a lot of people think that they'll be applying for scholarships to help pay for financial aid by applying to this group or that kind of thing. The truth is that the vast majority of money to pay for college comes directly from the colleges. So since that's where most of the money is, that's what we're going to talk about tonight. When it comes to gift aid, it's going to be based either on need or merit. And we'll spend a lot of time. You'll know everything you need to know about need and merit by the end of the evening. How much gift aid your student gets depends on the student's profile in terms of eligibility for need-based aid or academic or merit scholarships. That's one piece of the puzzle. The other piece of the puzzle is how colleges award aid, and that's very important. If you have financial need, then you want to try to find colleges that award need-based aid. On the other hand, if financial need-based aid isn't going to be the answer to how you pay for college, you probably want to look for colleges that award scholarships based on academics. So we'll talk about that in a lot of detail. Another thing to keep in mind is that what you want to focus on is your net price. And that's what we're going to be talking in terms of this evening. So the college cost minus the gift aid that you receive is your net price. And finally, affordability when it comes to paying for college is a matter of both the net price and the resources that are available to pay the net price. So we'll talk about that as well. So in terms of the agenda, we've got two major points. We're going to talk about assessing where you might get aid, and we're going to talk about how to decide what you can afford. Assessing where you might get aid is a matter of understanding that student's profile in terms of eligibility for need-based aid and how colleges award aid. Also understanding your student's profile in terms of eligibility for academic scholarships and how colleges award academic scholarships. Deciding what you can afford is making sure that you zero in on the true total cost and net price of a degree, understanding the resources that you have available to pay the cost. Typically, that's going to be savings and money that you can use out of income. If that's not enough, then you want to understand how much you'll have to borrow. And finally, you also want to be sure that the amount of debt is reasonable. So when people talk about the cost of college, they typically focus on the sticker price, which at USM is about $23,000 for a year. At Orono, it's about $25,000. At Bowdoin, it's about $71,000. But it turns out that colleges award a significant amount of gift aid, and that helps to reduce the cost of college. So the average net price for students who receive gift aid at USM is about $12,000. At Orono, it's $18,000. At UNE, it's about $34,000, and at Bowdoin, it's $24,000. But there's another wrinkle. It turns out that not everyone receives gift aid. So these are the percent of students who receive college-funded gift aid at these colleges. And you can see that at USM, Orono, and University of New England, it's 90% or more. At Bowdoin, it's only 51%. That means that 49% of the students who go to Bowdoin are paying that full $71,000 per year. When you factor that into the equation, it turns out the true net price for all students ranges from $12,000 at USM to $18,000 at Orono, $34,000 at UNE, and $47,000 at Bowdoin. So I'm not throwing all those numbers out to make things confusing, but what I want you to take away from this is it really doesn't matter what colleges charge. What matters is what you pay, and what you pay is your net price. That's the college's cost of attendance minus the gift aid that you receive in financial aid. Excuse me. So let's talk about the types of financial aid. There are two major categories of financial aid, and we've talked about them a little bit already. One of them is gift aid. This is free money, and this is what truly reduces the cost of college. Aid that's based on financial need is typically called grants. Gift aid that's based on merit is typically called scholarships. The other category of financial aid is called self-help, and this doesn't reduce the cost of college, but it can, in some cases, help you manage it. So self-help is made up of work study. That's a job that the student gets during the academic year and can use to pay for some college costs. And the other type of self-help is loans, money that you borrow to pay for college, but has to be repaid with interest. So when you look at it this way, it's pretty clear that gift aid is a much better deal than self-help. Unfortunately, colleges don't always make it easy to identify that and understand that. So this is a typical award letter from a college, and this is how colleges notify students of how much financial aid they're going to get. And if you look at the bottom line on this award letter, it's $22,200 for 1 year at this particular college. However, when you break it down, it turns out that out of the 7 line items on this award letter, 4 of them are gift aid, 2 of the lines are loans, and 1 of them is work study. So when you break it down by the categories, it turns out that the subtotal of gift aid is about $15,000, the loans total about $5,500, and the work study is $1,800. Now $15,000 is still a lot of money, but not nearly as good as $22,000. And there are some important things missing. What's the starting cost, and what's the net price? Your true cost, or the true cost for this student to attend this college for 1 year after gift aid. Well, I went online and looked it up, and it turns out that the total cost, which is called the cost of attendance, is just under $50,000. It's $49,765. When you subtract $14,900 in gift aid, it turns out that the net price for this student for 1 year at this college is $34,865. So keep this number in mind. We're going to come back to it at the end of the presentation. But for now, I want to get into a little bit more detail about gift aid. So we said there are 2 types of gift aid. One of them is need-based aid, and this is usually called grants. This is based on family income and assets. You apply for gift financial aid using the FAFSA, and that's required at all U.S. colleges and many international colleges as well. The FAFSA is required for gift aid and loans at all U.S. colleges. In addition to the FAFSA, there's a second financial aid application called the CSS Profile. This is required for college-funded gift aid at about 150 colleges. So the majority of colleges don't require the profile, but the colleges that do require it tend to be the ones that are more well-known, more famous colleges, and they tend to be more generous with need-based financial aid. So if you're going through the financial aid process, there's a good chance that you will encounter the profile. The other type of gift aid is merit aid, and this is typically called scholarships. This is usually based on things like grades, test scores, class rank. And this is often awarded automatically when the student is admitted to a college. So typically the college is going to send the student a letter or an email saying, congratulations, you've been admitted to our college and you're going to receive $15,000 per year in scholarships. Now, even though that's the way it typically happens, there are some cases where there's an additional application required for gift aid. So you always want to make sure that you know what's required for gift aid. You can find that out by looking on the financial aid pages of the college's website, and make sure that you read that carefully so you'll know what's required to qualify for the maximum amount of gift aid possible. So let's go into a little bit more detail about need-based aid, which we said is typically called grants. In the financial aid world, need has a very specific definition, which is COA minus EFC. That's the algebraic way of putting it. And that what need is your potential eligibility for need-based aid. It doesn't mean that's how much you're going to get. It's the maximum amount of need-based aid that you might possibly get. So let's break down that algebra. COA stands for cost of attendance, and that's always made up of 4 elements: tuition and fees, room and board, books and supplies, and then transportation and other miscellaneous expenses. EFC stands for expected family contribution. And this is the most misleading term in the English language, because if you look at it and read the words in English, it seems to say that that's what you're going to pay for college. However, it turns out that very few people actually pay the EFC. Usually they pay either more or sometimes less. Another important point, college aid policies vary. Some colleges meet full financial need based on the FAFSA or the profile. Other colleges meet little or no need. So this is why it's so important to match your student's profile with the awarding approach of the college that your student is considering. If you want to estimate your EFC, you can go to this website. And knowing what your EFC is helpful, but it's not sufficient. So what do I mean by that? Let's say you go to that website and you figure out that your EFC is $35,000. Well, what that will tell you is that the University of Maine, you qualify for 0 in gift aid, or need-based gift aid, because the cost at the University of Maine at $25,000 is less than $35,000 EFC, so there's no eligibility for aid. On the other hand, at Bowdoin, where the cost is $71,000, then you might qualify for as much as $36,000 in gift aid. It doesn't mean that's how much you're going to get, but that's the maximum that you might be eligible for. And another thing to keep in mind is that each college defines its own idea of need. And their idea of need is typically not the same as yours. So we said that EFC determines need-based eligibility. So let's go into that in a little bit more detail. There are 2 EFC formulas, one based on the FAFSA and one based on the profile, but they both use the same basic approach, which is to look at the income and assets of the parents and the student. So there are actually 4 different calculations going on in the background when the EFC is calculated. There's a parent contribution from income, parent contribution from assets, and then student contributions from income and assets. So here, a lot of people think that their assets really hurt them for financial aid. And it's true that they are considered as part of the formula. However, for most people, income plays a much bigger role in determining the EFC than assets do. So you can see that the maximum rate at which income is assessed is 47%. What that means is that once you have the certain minimum amount of income, every additional dollar adds 47 cents to the EFC. When you reach the maximum amount of assets, every additional dollar of assets adds about a nickel to the EFC. So you can see that income plays a much bigger role in most cases in determining the EFC than assets do. For students, the contribution from income is typically not too significant because the first $5,000 to $7,000 of student income is not a factor in the formulas. And most high school students don't exceed that. It is sometimes the case that students may have assets in their own name. And here, student assets are assessed at 20 to 25%, significantly more than parent assets. In this case, it's disadvantageous to have assets in the name of the student. Each $1,000 of student assets adds $200 to the EFC, where each $1,000 of parent assets adds $50 to the EFC. There is a loophole, and unlike most loopholes, this is actually available to almost everyone. If there happen to be assets in the name of the student, if you convert those to a student-owned 529, then those assets will be treated as if they were parent assets. So that's one planning strategy that could be available if you find yourself in this situation. Now, I want to kind of highlight, you've probably taken it away, but a lower EFC means greater eligibility for need-based financial aid. So in thinking about whether you might get need-based aid, a lower EFC is always better. So there are some special cases that we ought to talk about in determining what the EFC is. One of them is when there are multiple siblings in college at the same time. And in this case, the parent portion of the EFC is going to be shared among the siblings. So that can have a pretty significant impact on the EFC. A lot of families might have the older child go to college in year 1, and then maybe in year 2, there's a second child who goes to college. And it turns out that the EFC is dramatically lower when there are multiple siblings in college at the same time. So it might be the case that you don't qualify for need-based aid in year 1, but you might in year 2 if there are more than one in college. Another thing to keep in mind is that when the EFC is calculated, they're looking at income that was earned in the past. And in some cases, your income may have changed since the year that's being considered, particularly this year with all of the financial hardships associated with the pandemic. In that case, what you need to do is to fill out the FAFSA and the profile based on the income year that they're asking about. For a senior in high school this year who's going to graduate in 2021, they're looking at 2019 income. But if your income has gone down, what you want to do is after you file the FAFSA and the profile, you want to go to each college that your student is applying to, let them know that your circumstances have changed, and ask them if you can appeal for consideration for additional aid. The final special circumstance that I want to talk about is when the parents are divorced or separated. And here, the way the FAFSA treats this case is much different than the way the profile does. For the FAFSA, they are going to be looking at the custodial parent only, and if that parent has remarried, they will be looking at the new spouse as well. The profile is going to look at both biological parents, regardless of who the student lives with. And if those parents have remarried, they'll be looking at the new spouses too. So the profile may be looking at the income and assets of as many as 4 different people. Now, they will do some calculations in the background that are intended to put the primary burden for college on the biological parents, but those calculations are not always perfect. And I should point out that on the FAFSA, the definition of custodial for financial aid purposes is very different than what it is for a divorce decree. For financial aid, custodial means the parent with whom the student lived 50+% of the time. So it doesn't matter who's the custodial parent in the divorce decree. It doesn't matter which parent claims the student on his or her income taxes. What matters is who the student lived with more than half the time. All right, so what we've been talking about so far is identifying what the student's profile is in terms of need-based aid, what that student's potential eligibility is for need-based aid. If you find that your student has financial need, you would like ideally to find colleges that meet that need. That way you can match the student's profile with how the college awards aid. Well, this is a great website that the College Board maintains. And if we look at the University of Maine at Orono, we see that at UMaine, they meet 73% of need on average. Out of that 73%, they meet 54% of it with gift aid. 46% of the 73% is met with self-help. When you multiply 73% of need met times 54% of need met with gift aid, it means that on average at Orono, about 39% of need is met with gift aid. Now, Orono is almost always going to be affordable for a Maine resident, but that's because the starting cost is very affordable, not because the need-based aid is necessarily extremely generous. At NYU, they meet 71% of need on average, and of that, 77% is met with gift aid. Multiply them together, and that means that about 55% of need is met with gift aid at NYU. At BU, they meet 93% of need, and they meet 80% of it with gift aid. So on average, about 74% of need is met with gift aid. At Colby, this is an example of kind of a gold standard of need-based aid. They meet 100% of need, and of that, they meet 92% of it with gift aid. So if you have financial need, Colby is likely to be more generous than BU, which is likely to be more generous than NYU. Now, what we've been talking about are averages. They give you an idea of where to look if you're looking for need-based aid, but they don't tell you your true cost, and we'll get to that in a couple of minutes. I want to talk about the timing of the FAFSA and the profile. We mentioned that the income that these forms look at is income that was earned in the past. So for high school seniors who will be graduating in the class of 2021 and starting college in the fall of 2021, the FAFSA and the profile are going to look at income that was earned in 2019. That means that you filed your taxes in April, typically, or perhaps July of this year. Now, in the fall of 2020, you're applying to colleges. Very soon, or at around the same time your student is applying, you should be filing these financial aid forms. And that way, the colleges can give you estimates of what your aid award is going to be at about the same time they notify your student whether or not they've been admitted. So income is looked at for a prior year. Assets are valued as of the date that you file the financial aid forms. So if your student is a senior, your student is going to be applying to colleges soon, typically, so you'll be filing the FAFSA and the profile soon. Ideally, when you file the FAFSA and the profile, if you can, you'd like to file it in a way that makes you eligible for more aid. And this is kind of a planning tip. If you have expenses that you know you need to make, you might be better off to pay those expenses before you file the FAFSA and the profile. An example of this might be estimated taxes for someone who's self-employed. You might, in this case, be better off to pay your estimated taxes a little early, then file the FAFSA and the profile so that your assets are reduced. I want to give you just an outline of the years that will be of the calendar for financial aid that's going to apply for seniors, students who will graduate in 2021 and will be in the college class of 2025. For the first year of college, they'll be looking at 2019 income. The second year will be 2020, the third will be 2021, and the fourth will be 2022. Well, it turns out that 2022 is the year that ends when the student is a sophomore in college. And here's another potential planning tip. If the student is lucky enough to have a grandparent who would like to help pay for college, one of the things that you might want to think about is the timing of when the grandparent makes those college payments. If the student is eligible for need-based aid, payments from the grandparents are considered as additional income to the student and potentially could decrease their eligibility for need-based aid. However, if the grandparents wait until after January 1st of the student's sophomore year of college, the final income year for financial aid purposes will be over, and those grandparent payments will no longer have an impact on eligibility for need-based aid. If the student isn't getting need-based aid anyway, it doesn't matter. This is only an issue if the student is qualifying for need-based financial aid. So I'm going to show you the years for juniors, sophomores, and ninth graders as well. And as I mentioned, if anyone would like a copy of these slides, my email will come up at the end of the presentation, and I'll be happy to email these to you. All right, so let's say that you may have financial need. What you want to understand also is need-based aid going to make college affordable? So I want to show you an example of how a very generous full-need college awards its financial aid. And this is an actual college that I'm aware of. This college has a starting cost of $72,000, and we want to imagine a family where the student has an EFC of $30,000. Well, when you subtract $30,000 from $72,000, there's $42,000 of financial need, potential eligibility for need-based aid. It turns out that when the college awards aid, it's going to meet the first $4,500 of need with a loan. It's going to meet the next $2,200 with work study. Only after loans and work study have been awarded will it meet the remainder of the need with gift aid. So the grant in this case is going to be about $35,000. You subtract $35,000 from $72,000 to get the net price, and the net price for the first year at this college is about $37,000. So it's $7,000 more than the EFC. In year two, it's a similar pattern, except that the loan amount goes up by $1,000, so the net price increases to about $38,000. And the same pattern repeats in years 3 and 4. So by the end of college, this college has met full need of $168,000. It's met the need with $24,000 in loans, $8,900 in work study, and $135,000 in gift aid. The sum of the EFC for the 4 years is $120,000, but the net price for 4 years is $153,000. This is a generous college, as I mentioned, and this example doesn't include inflation. So if you want to understand if need-based aid is going to make college affordable, here's a good rule of thumb. If your EFC times 4 plus about $40,000 is not affordable, then need-based aid may not be the answer to your college affordability dilemma. All right, so we've talked about the student's profile in terms of eligibility for need. We've talked about how colleges award need-based aid. I want to talk now about merit aid. And to understand merit aid, you need to understand a little bit about the business of college. So when students and families think about college, they typically focus on the acceptance rate. That's the percent of students who apply to a college who are offered admission at that college. Harvard, as you know, is very difficult to get into. 5% of the students who apply to Harvard are offered admission there. At Northeastern and BU, it's about 20%. At Ohio Wesleyan and Susquehanna, it's 67 and 85%. Well, colleges pay attention to the admit rate for sure, but they also focus on another number, which is called the yield rate. And the yield rate is the percent of students who were admitted to a college who end up attending that college in the fall. At Harvard, 4 out of 5 students who are admitted to Harvard end up going there. At Northeastern and BU, it's about 1 in 4. And at Ohio Wesleyan and Susquehanna, it's 14 and 15%. Well, when that yield rate gets into the 20% and below, colleges really worry about having enough students attending the college and paying tuition in order to pay their bills. So what do? They discount their price with financial aid in order to compete for yield. And their thinking is, well, we might not get the full price if this student comes to our college, but at least we'll be getting some money that will help to pay the bills. So this third column is the percent of students receiving college-funded gift aid at each of these colleges. It might be need-based aid or it might be merit aid, but it's the amount that the college is discounting its price overall in order to get students. So at Harvard, it's 57% of students are receiving college-funded gift aid. Now that's all need-based aid. Harvard doesn't use any merit-based aid at all. At Northeastern, about 3/4 of students are receiving college-funded gift aid. And at Ohio Wesleyan, Muhlenberg, and Susquehanna, it's 94% or greater. Almost everyone is receiving some form of college-funded gift aid. So that leads us to the discussion of merit aid or scholarships, because that's how colleges decide how to award some of their college-funded gift aid. The factors that go into determining how much merit aid a college might award are high school GPA, class rank, test scores, and there are some other factors that go into it as well. Now, if your student in this year was unable to take the SAT or the ACT, don't worry. Colleges will figure out alternative ways of awarding aid if test scores aren't available. But these are kind of the typical ways that they do it. Another thing to keep in mind is that merit aid is most common at private colleges, although more and more public colleges are using it now as well. This is really important. When it comes to merit aid, the highest awards go to the strongest students relative to the other applicants to that college, which means that your student may end up getting the highest merit aid at colleges that they consider their safety schools. So safety schools for admission may also turn out to be safety schools for financial aid. And again, college aid policies vary. Some colleges use no merit aid, as we saw in the case of Harvard. Other colleges use a lot of merit aid. And you really get one major bite at the apple. Transfers typically get much less merit aid than first-year students. So the merit aid that your student might be offered as a first-year applicant is likely to be the best merit offer that they're going to get. So I want to show you some examples of a few colleges and how they award merit aid. So I've got the statistics on here of their admit rates, their yield rates, their starting cost, and the percent of students who receive college-funded aid. At Gettysburg College in Pennsylvania, their highest merit award is $32,000 per year, and that goes to students with a combined SAT score of 1450 and a 3.8 GPA. At Tampa in Florida, their highest award is $15,000, and that goes to students with a 1380 combined SAT. At Eckerd, their highest award is $22,000, and it goes to students with a 1310 SAT. And you can see some of their lower merit awards as well, and the SAT scores associated with them. Well, watch what happens when I layer in the 75th and 25th percentiles at these colleges. The 75th percentile means that 25% of the students at that college scored higher. So at Gettysburg, 25% of students scored higher than 1410 on their SAT. And you can see that Gettysburg's highest merit award is a little bit above that 75th percentile. Their lower award is very close to the 25th percentile. And it turns out that that's the case at Tampa and Eckerd as well. And in fact, you can make some generalizations about this. If a college uses merit aid, the best chances for a large award are when you're above the college's 75th percentile. If a college uses merit aid, the awards may phase out when you reach about the college's 25th percentile. However, colleges that compete aggressively for students may award merit aid to nearly everyone. So, which colleges award merit aid? This is a great website maintained by the government called College Navigator, and this is where I get those statistics for the percent of students receiving college-funded gift aid. And you can see at Gettysburg, it's 87%. At Washington College in Maryland, it's 100%. So here's the rule of thumb if you're looking for merit aid. If that percent of students receiving college-funded gift aid is over 60 to 65%, then it's a good chance that the college uses merit aid. If it's over 80%, it is highly, highly likely that the college uses merit aid as part of its aid awarding strategy. So, where might your student get merit aid? What I want to do is show you an example of a student with an 1150 SAT, and let's identify some colleges where that student might get some merit aid. US News keeps statistics about this, and they publish them every year. And if you look at Shenandoah University in Virginia, their 75th percentile SAT score is 1123. This student's SAT of 1150 is above that, so this student is likely to qualify for one of the higher merit awards at Shenandoah. This student is also above the 75th percentile at Suffolk in Boston, Old Dominion in Virginia, and UMass at Dartmouth. Now, you don't need to necessarily be above the 75th percentile. If you're pretty close, you're probably also going to be in the running for a pretty good merit award. And when you look at it that way, it turns out that this student is in the running for a pretty good merit award at University of Maine, at Pace in New York City, or at Lesley in Cambridge. So this is a way that you can kind of identify some schools where your student might be likely to get college-funded merit aid. Here's a summary of the way colleges award aid. And I break down the colleges into 4 categories that I call the elite, the near elite, the mid-market, and other. And it turns out that at those elite and near elite colleges, they tend to have generous need-based aid policies. They often meet full need, and out of that, they often meet a very significant portion with need-based aid. On the other hand, they award very little or no merit aid. So those colleges include Stanford, Amherst, Pitzer, Carleton, Harvard. They're some of the famous colleges that you typically hear of often when you're thinking about colleges. At the mid-market and other colleges, they gap. What that means is that there's a gap between the amount of need that a student might have and the amount of need-based aid that the college awards. However, those colleges often use significant amounts of merit aid. So if your student has a high need, those mid-market and other colleges might not be the best bet. But if you're looking for colleges that award merit aid, they might be a good place to consider looking. It turns out that there are about 80 or 100 colleges in that elite or near elite category. There are about 2,000 colleges in the mid-market or other category. So if you are looking for colleges that might award merit aid, there are a lot of choices to consider. All right, so we've talked about need-based aid, we've talked about merit-based aid. Now let's talk about how you can estimate your individual net price. The way to do it is to use a tool called a net price calculator. Net price calculators will give you the cost of attendance, the estimated gift aid, and then the net price. Net price calculators are required by law. Every college must have a net price calculator available. However, the law does not require them to be reliable. Here's how you can tell when a net price calculator is reliable or not. If it is super easy to use, takes about 10 or 15 seconds, asks maybe 4 to 6 to 8 questions, it's no good. It's not asking enough for enough information to give a reliable estimate. If it's a pain in the neck to use, it might take 10 minutes or so to go through. It's asking you for a lot of different details. Then there's a good chance that that net price calculator is asking for enough information to give you a reliable estimate. And when you're using a calculator, remember the cost of attendance minus the gift aid equals the net price. Now this is an example of a display of an output of a net price calculator. And if you are not a numbers-oriented person, this display might be a little bit intimidating. Don't worry. Go back to the fundamentals. Remember, net price is cost of attendance minus gift aid. Cost of attendance is always made up of 4 elements: tuition and fees, room and board, books and supplies, and transportation and other. You subtract from that the total amount of gift aid, and the result is the net price. So just make sure that you keep your eye on those essential elements, and you'll be able to interpret these net price calculators so that you can really estimate what your student's true cost might be at different colleges. When you use a net price calculator, what you want to do is to be able to compare prices side by side. And here's where I want to pause for a second and remind you that there's more to college than just the price. We've been talking about dollars and cents because obviously that's important. But you also want to find a college that's going to be the right academic fit for your student, offer the right majors, have a social environment where your student can really have a good experience while they're at college. So the idea is not necessarily to find the cheapest possible college. The idea is to find a good college that meets your students' needs and is affordable. All right, so with that, let's look at an example. This is a case where the EFC is 15,000, that's the student's need profile, and the student has B- to B grades in an 1100 SAT. That's the student's merit profile. So let's look at the estimated net price at various colleges. At Roger Williams, the starting cost is $58,000. This student is likely to get a merit award of about $13,000, an additional $5,500 in need-based aid, for a net price for 1 year of $40,000. At Shenandoah, the net price is about $35,000. At Eaton, it's $25,000. At Orono, it's $22,000. At Bowdoin, it's $17,000. And at USM, living with parents and commuting, it's about $10,000. So a couple of things I want to point out. Bowdoin at $17,000 is a great net price. It's only $2,000 more than the EFC. However, a B- student is probably not going to get into Bowdoin. And that's why those colors are there. The gray means not very likely. Dark green means highly a good fit or a good match. And then the lighter green means maybe yes, maybe no. Another thing to point out, I know that going to USM, commuting from your parents' house, is not the same as going away to college and living in the dorm. However, I put that example on there to remind people there is an affordable path to college for everyone. It may not be what you've always dreamed of. It may not be the dream school, but the student is far better off to get the benefits of that college degree without overburdening him or herself with debt. And if that's the only way to do it, then making that decision for the 4 years of college will mean that the student will be in a much happier position once the student gets age 22 or 25 and won't be kicking themselves about the college decisions that they made. All right, so we've talked about need-based aid, we've talked about merit-based aid, and we've talked about how to estimate your individual net price. Now we're coming to the end. I want to talk about paying the net price. So we've looked at gift aid. Remember that the net price is the starting cost minus gift aid. Keep in mind that that includes scholarships, and that additional scholarship aid is very rare. So that net price is likely to be about what you're ending up paying for college. The net price is going to be paid from income that you earn over time. What do I mean by that? It might be savings, money that you earned in the past and saved. It might be current income, money that you earned during the college years and used to pay for college costs. Or it might be future income, money that you earn after college and use to repay debt that you took out to pay for college. So those are the sources of how to pay for the net price. Let's talk about whether the net price is affordable. And here I want to go back to that example we were talking about at the beginning of the presentation. We said that the net price at that college whose award letter we looked at was $34,865 for 1 year. But the cost of a degree is going to be paid over 4 years. So there are a couple of important questions that we need to ask. One of them is, how much are the costs going to increase? And another is that gift aid automatically renewable and on what terms? This is a really important question to be sure you understand before you make a commitment to any college. Usually colleges will be fairly clear, either in their award letter or on their website, of what it takes to renew gift aid. Typically, merit aid is renewed as long as the student maintains a certain minimum GPA in college, and need-based aid is renewed as long as the family's income and assets remain pretty consistent over time. If you have any questions about it, be sure to ask the college what their renewal terms are. So for this example, we're going to assume that costs increase 2% per year, that the aid is renewable and constant for 4 years, And we're going to assume that the student has $2,000 in savings and the parents have $25,000 in savings. And that savings is not their emergency savings, not their retirement, it's money that's available to pay for college. So how are we going to pay for that degree? Well, at 2% per year, that $35,000 college turns out to be $145,000. When we go to pay it, we're going to look first to the student. And the student can get a financial aid award at this college for $1,800 a year. The student can also take out federal student loans. If you're going to need to borrow for college, federal student loans are always the first place to look because they're guaranteed availability, the interest rate is reasonable, and there are protections for the borrower after college if they run into trouble. After this, we're going to look at that $2,000 in savings that the student had. Remember when we were looking at the EFC, we noted that student assets are assessed more heavily than parent assets. So if we use the student savings first, perhaps there might be a little bit more eligibility for need-based aid in years 2, 3, and 4. After that, we're going to look at the student getting a summer job. So if the student gets a summer job each year before college, if they make $10 an hour and work 40 hours a week for 10 weeks during the summer, the student will earn $4,000. They're going to pay taxes, they're going to go to Old Orchard a couple of times, but they should still be able to save $2,000 each year to use for college expenses. Now we've used up what the student can contribute. At this point, we've got to look to the parents. So in this case, the parents are going to look at their budget and they're going to say, okay, we think we can save about $375 out of our ongoing expenses that we can pay out of income each year during the student's college. That adds up to $4,500 per year. We also said that parents have some savings. So if they use $19,000 of their savings, that fully pays for year 1 at this college. In year 2, we're going to use the balance of the savings that were available to pay for college. At this point, we've used up all of the resources that this family has available to pay for college. The only thing to do now is additional borrowing. And this additional borrowing is something that I consider a parent responsibility. Sometimes people think, well, the student should pay for that additional borrowing. But the student has no job, no credit history, no collateral, so the lender is almost always going to look for a cosigner, and that's typically the parent. So in this example, the parents are going to have to borrow $15,000 to fully pay for year 2, $21,000 for year 3, and $22,000 for year 4. So we've fully paid for this college now using prior income, current income, and future income. We've ended up with $27,000 in student debt and $58,000 of parent debt. We don't yet know if this amount of debt is sustainable, if it's a good idea or not. One of the things we need to know to answer that question is, how much are federal loans going to cost? Now this year, in the year of the pandemic, interest rates on student loans have gone down. What I'm showing you are the loans that have been in effect for the last several years, because I think that that's a more realistic and conservative way of estimating cost. So for student loans, the typical interest rate is about 4.5%, and they are repaid over 10 years, beginning 6 months after the student graduates from college. Parent loans typically carry about a 7% interest rate. At those interest rates and paid over 10 years, that means that for every $1,000 of student debt, the student is going to have to pay back $125 per year for 10 years. For every $1,000 of parent debt, the parents are going to have to pay $140 a year for 10 years. So for the student with $27,000 in student debt, 27 times 125 It's $3,363 per year that the student needs to pay back for 10 years. For the parents, 58 times 140 means that they have to pay $8,110 per year for 10 years. So that tells us how much the loans are going to cost. It doesn't tell us whether it's a good idea or not. Thinking about that, my rule of thumb is that payments for education debt should not exceed about 10% of gross income. So looking at the student with $27,000 in student debt, the annual payment is a little under $3,400. To keep that within 10% of income, that means that the student needs to get a job after college that pays about $34,000 a year. The good news is that the average new college graduate makes about $40,000 a year. So in my mind, borrowing $27,000 in student debt is not a bad trade-off for the benefits that a college education provides. For the parents, it's a different story because they also need to consider their other obligations, retirement, college for other children. And in this case, I see a big red flag. When we were talking about parents, they said that they could afford $375 a month to pay for college. That's $4,500 a year. What makes them think if they can only pay $4,500 a year during college, that after college they can all of a sudden pay $8,100 a year? To me, this looks like it's not a sustainable cost for this family. So when I work with families, and what I recommend for you all is to identify the estimated 4-year cost of different colleges, and then identify what your zone of affordability is. In other words, pick that price point that you can afford. That price and anything lower will be your zone of affordability. When I'm thinking about it, I typically try to look for what I call the parent debt-free point. That's the price at which the parents don't need to take on any debt to pay for college. The student might take out $27,000 in federal student loans, but the parents at that price don't have to take on the additional debt. And these are some of the factors that go into each family's decision about how to identify that zone of affordability. So one of the questions that comes up a lot is, how does everyone else pay for college? And the answer is exactly the way I've been describing to you this evening. There are prior income, current income, future income from the parents and the student. The student, on his or her own, can automatically pay for about $43,000 worth of college. That's made up of the $27,000 in federal student loans that the student can take out, and $2,000 per year in work study, plus $2,000 per year in summer earnings. If $43,000 isn't enough, then you must have a combination of either a college with a lower net price or more resources in the form of either savings from the parent or the student, or income from the parents, or debt from the parents. All right, so we've talked about a lot of heavy stuff. I think it's helpful to try to keep it in a little bit of perspective. And one of the things that I think happens when you're thinking about college costs is that you might go through those stages of grief. Get it out of the way now. It's much better to get through this stages of grief before your student applies to college than after your student has been admitted to a lot of colleges, and only then do you have to say, ooh, it doesn't look like we can afford that. Another thing to keep in mind is that college is important, but it's not the goal. The goal is to set your student up for success after college. And when you think about your own work life, your own career, you'll probably notice that what really matters when people are being hired is what they've done, and what they're going to do for their employer. It really doesn't matter nearly as much where they went to college. Another thing that helps to keep things in perspective is to look at these pretty successful people. The head of, or the founder of Starbucks went to Northern Michigan University. The longtime CEO of Walt Disney went to Ithaca College. And the current CEO of Hershey Foods went to Shippensburg University in Pennsylvania. These colleges are great colleges, but they're not Ivy League. They're not the big brand name colleges that people so often think about and often think that they might be willing to pay for no matter what. Another thing that helps keep things in perspective is to think about the earnings potential. So graduates from Colby, American, and Clark in the middle of their career, when they're age 35 to 45, typically make a little over $100,000. And the difference between the high earnings and the low earnings of these three graduates is about $2,000. However, the difference in the four-year net price to attend these colleges is almost $80,000. So if you pay that extra $80,000, it's not necessarily going to pay off in terms of earnings power after graduation. So when your student is looking for colleges, you'd like to make sure that they have on their list some financial safeties, some colleges that you can be confident that you can afford. One approach is to use the numbers, such as we've gone over tonight, to identify your student's profile and identify colleges who might meet that profile. Another approach is to seed your list. And what I mean by this is if you put on the student's list colleges that have different approaches to the way they award financial aid, there's a good chance that some of them will end up being affordable. So for every Maine student, they should apply to one of the UMaine campuses. Maybe they apply to an out-of-state public flagship college. Maybe they apply to a secondary out-of-state public like Keene. If the student has high financial need, then those highly selected private colleges are a good bet to meet that need. If the student needs to look for merit aid, if need-based aid isn't likely to make college affordable, then there's a group of colleges called Colleges That Change Lives, and they frequently use merit aid as a way to attract students. And don't forget, there is an affordable path to college for everyone, so commuting and going to USM is always going to be affordable for every student. I want to highlight an opportunity for Maine residents. If you're not already participating in a 529 account from FAME, this is the one that's administered by Merrill Lynch. If you contribute $1,000 a year to that 529, the state will also give you an additional $300. So that's free money there for the taking. All you have to do is sign up and contribute. Not only will you get the free money, but you'll have a little bit more savings available for college. So in this crazy year of the pandemic, there are a lot of questions that might not always come up. So let's talk a little bit about how COVID is going to impact college and college financial aid. If your income was or will be impacted by the pandemic, you're going to need to use 2019 income on the FAFSA in the profile. But be sure to contact each college that your student applies to, contact them individually and explain the new circumstances and ask them if they will consider you for additional aid. Colleges have taken a big hit this year. It's been very expensive for them. And my instinct is that colleges are likely to use early decision more as a way of making their classes. Early decision is a way that students apply in which they sign a contract and say that if you admit me to this college and you award me enough financial aid to make it affordable, then I guarantee I will go to your college. Early decision is often an advantage for admission, but it's more often than not a disadvantage for financial aid. because with early decision, you're not going to have a variety of aid awards to compare. So this is not necessarily a good thing for students applying to college this year, but I do think that it's likely to be the environment that we're living in. This next point may be a silver lining for students who are graduating in the class of 2021 and applying to colleges. Most colleges for this year have gone test optional, even for merit aid. That takes a lot of the pressure off. If your student has not been able to take the SAT or the ACT, or if their scores are not what they had hoped, they probably will be able to apply to college on a test optional basis. A lot of people are worried that because of the financial pressure that colleges are under, that they're likely to award less in financial aid. I think that that's not likely to play out that way. I think colleges will need to award even at least as much, maybe even more aid than they usually would, because that financial pressure makes it even more important that they recruit enough students to fill their classes. And so I think that the likelihood is very high that colleges will continue to use both need and merit-based aid to attract students. And the final point is really not COVID specific, but applies in all years. And that is that it always is possible to ask a college for more financial aid. You're in a much stronger position if you have multiple offers to compare, and the worst a college can say is no. So it certainly doesn't hurt you to go back to that college and say, hey, my student really likes your college, but it looks like it might not be affordable. Can you offer a little bit more financial aid? So we're just about done. I really appreciate everyone joining tonight and sticking with us. I have a website here that has some additional resources if you want to read more about the financial aid process. And if you'd like a copy of these slides, I'll be happy to email them to you. That's my email address. And if you email me after the presentation, I will send you the slides.